Alright, hi guys. So ever since Jerome Big Mouth Powell did a clubber lang on the markets, you can see that it's been down for 1, 2, 3, 4, 5 days in a row, and it's a hair away from the 17 June low. So markets are way oversold right now, and again, when markets are way oversold, there's a very high chance we're going to have a snapback. We're going to have a rally snapback. And we're coming towards the last 3 months of the year where the market tends to rally. So like I said, there is a chance, there's a high chance we may retest that low and then rally from there. But what if we break that low and we don't rally? What if we break that low and we keep going down? So how much lower could it go? Let's explore this in this video. Before that, I've got even more bad news. It seems that we are right now in a severe global recession, according to Davis Research. Now, this article came out on Bloomberg today. It says everything sell off, stocks and bonds, everything is collapsing because there's a 98% chance of a global recession happening right now. It says a global recession probability model by Davis Research recently rose above 98%, triggering a severe recession signal. The only other time the model has been this high was during the previous acute downturns like 2020, the pandemic, and 2008, 2009 global financial crisis. Ooh, that sounds really scary. Now, let's take a closer look at this model, shall we? Okay, so here we are. So right now, September 2022, this recession probability model, again, you can see has hit 98%. So again, 98% chance we are in a global recession. So what does it mean? Does it mean that we should panic sell everything because we're going to go to hell? Because it's going to get worse? Or is it a time that the market may actually bottom? Okay. So let's take a look at previous times when this model hit 98%. It happened twice since 1988. It happened here in 2020. It happened here during the great financial crisis. And you can see that when this model made that exact same signal over here, where was the stock market? The stock market was at the bottom. In fact, at the early stages of the new bull market. Same thing over here. By the time this signal came in and said, we're in a recession, where was the stock market? The stock market was at the bottom. How can this be? Why is it that when this model tells us that it's a recession, the stock market has actually bottomed and near the bottom and is like going up? Why, right? Because remember that all these models are lagging indicators. By the time they tell you it's a recession, it's already in a recession. In fact, it's during the middle of the recession or towards the tail end of the recession. So you can see other times when it went above a 70% probability. Let me put it in here, right? So it happened over here, over here, over here, over here, over here. So all these times, the probability of a recession went above the 70% mark. And notice, by the time this signal came in, the economy was already in the middle of a recession, towards the end of the recession. This gray shaded area represents the recessionary periods. So again, check this out. By the time this signal came in, it was at the end of the recession. This signal came in at towards near the middle of the recession, almost towards the middle. This came in at the middle of the recession. This came in at the end of the recession. This came in at the end, came in at the middle, at the end, at the middle, at the end, and at the middle. Now, some of you may be wondering, hey, this shaded area represents recession. So how come we are not yet in a recession based on this chart? Why is there not a gray line over here? Well, that's because the NBER, the National Bureau of Economic Research, has not officially declared a recession. Once they declare it, they'll say, okay, it started on this date, then they would have this shaded graph. Now, here's the problem. Historically, by the time the NBER declares a recession, it is usually 7.8 months after the recession began. right? So in other words, it's only after the recession has started, 7.8 months later, when it's going to end, do they say, hey, we were actually in a recession? So it's always a lagging indicator. So I'm not saying that right now is the bottom, right? I can't predict for certainty. We could still go lower. But what I'm saying is be careful when you read articles like that. A lot of people, they read these articles and they get really emotional, they get really scared, and they sell because they think that we're going to go into a global recession, it's going to get worse, so I'm going to sell everything. And more often than not, check it out. Historically, if you had sold every time the market went above 70% recession, you would have sold near the bottom of the market. Right? If you sold there, you would have sold the bottom of the market. You've sold the bottom of the market. Now, in this case, sure, you sold and then it went lower, right? Yeah, I mean, it's not perfect, okay? That you sold at the bottom of the market. Sold at the bottom of the market. So we're halfway to the bottom. Sold at the bottom of the market. Sold after the market bottom. Sold at the market bottom. Sold after the market bottom. So you can see that historically, more often than not, when there's a global recession signal, more often than not, the market is very near or at a bottom. Not all the time, but more often than not. So I would much rather be a buyer of stocks right now than a seller of stocks. All right, so let's go back to our earlier question, which is what is the potential downside of the market if it breaks those lows? How much lower can it go? And again, if you listen to the media, you've got people saying that, hey, the market could drop another 50%, another 30%. Well, everything is possible in the markets. But I think that before you make a decision or before you have like a target, you can't just pull it out of your ass. You can't just say, I feel it's going to drop another 20, 30%. You have to base it on numbers. You got to do some research. So what I decided to do was to plug in some numbers to kind of like calculate what's the fair value of the S&P 500. So to do that, I'm going to use a discounted cash flow model using this S&P 500 intrinsic value calculator. Now, first of all, I did not create this calculator. I'm not that smart. So this was actually this calculator was created by Professor Aswath Damodaran. And he's a professor of finance at NYU. So he created this valuation calculator and kindly shared it. So I'm using his calculator. So got to give credit where credit is due. Now, so what should the S&P 500 be at? It depends on two things. Well, actually many things, but two main things. Number one, it depends on corporate earnings. Remember, at the end of the day, it is the earnings of the company that determine the value of the companies, right? So we're going to make some assumptions on corporate earnings. Number two, it depends on the risk-free rate, also known as a 10-year treasury yield. Currently, the 10-year treasury yield as of right now is at 3.838%. Well, let's just use 3.8%. So let's plug that into the model right here. 3.8%. Which is the long-term risk-free rate or the 10-year treasury yield. Now, will the rate remain at 3.8% or higher in the long run? I don't think so. Now, what drives the 10-year yield are inflation expectations. So when people expect high inflation, the 10-year yield goes up. And you can see from the chart over here what happened. So in the long run, you can see that the 10-year yield has actually been going down for the last 40 years. But because now we had crazy inflation that has driven up the yield all the way up to 3.8%, and that is what has been causing the stock market to come down. So the question is, will this continue to go up or stay at a very high level? Excuse me. Or do I expect the 10-year yield to come down? Now again, different people have their own opinions. My opinion is that the 10-year yield will come down in the next couple of years. Okay, you'll come back down to probably 3% or lower. Why? Few reasons why. First reason is I believe that inflation has really peaked and inflation is decelerating. And one good leading indicator is the 5-year break-even inflation rate. All right, so there we are. And you can see what has happened to the leading indicator of inflation. It peaked right there and boom, it's gone all the way down to 2.33%. So that means that in the next 5 years, inflation will, it's not a guarantee, but likely to go back down to 2.33%. So inflation has peaked, is coming down. I know that, I believe that without a doubt, right? So because of that, I believe that the 10-year yield will eventually come back down. That's the first reason. Second reason is this. Remember that the Federal Reserve, the US government will not allow the yield to remain high for too long. Why? Think about it. If the yield is, say, at 4%, that means if the US government borrows money by selling bonds, they have to pay an interest rate of 4%. You know, how long can they do that? They'll go like freaking broke, right? So for the government, they want the yield to be as low as possible so they can lend money and pay less interest. So it's not in the government's interest to keep yields high. They want to get yields back down once inflation moderates. So because of that, my assumption in this model is to say, yes, the risk-free rate after year 5 will drop back to 3%. Now, I think it's going to happen before year 5, but based on this model, it's at least 5 years. I'm going to put it at 3%. Now, that's my assumption. If you say, I don't agree with that, I think it's going to go up to 4%, I'll put in that scenario as well later on. But my base case is that it's going to go down to 3%. All right. Now, next, in this model, what we have to do is we have to project what are the earnings per share of the S&P 500. So these are the expected earnings in 2022, 23, 24, 25. These are the projected earnings. Now, where did this come from? All this has come from the analyst consensus estimates, which you can get at Davis Research. So it's all here. So if you plug in $225 earnings per share for 2022 and $243 earnings per share in 2023, plug that into the formula over here. There we go, 2022-25, 243, and assuming 6% growth in 2024, 4% growth in 2025, 3% growth in 2026, right? So we're kind of like lowering the growth rates as we go along. And if you calculate using a terminal value, you get an intrinsic value of, ta-da, 4121. So assuming that corporate earnings meet analyst expectations, the S&P 500's fair value is at 4121. So let me write that down. So currently S&P 500 is at 3655. If the companies can meet analyst expectations, right? Meet expectations, then the S&P should be at 4121. So this implies an upside of about 13% above current levels. So most of the time, do companies meet expectations, or do they beat expectations, or do they disappoint below expectations? Let me just show you this historical chart over here. So you can see that historically, now this goes back to 1987. You can see that most of the time during the earnings season, companies will report earnings above expectations. So you can see anything above the zero line would be what we call an earnings surprise. For example, the last quarter, quarter 2, companies announced earnings 5% above expectations. And during 2021, they were like 20% above expectations, 15% expectations. So most of the time, companies announce earnings above expectations, but we're assuming that they're just going to meet expectations at 0. Now, of course, let's take a look at the pessimistic scenario. What if companies miss expectations because of this earnings contraction, because of this severe recession that we're supposed to be in? Well, let's see how bad it was. You can see that back in the last recession over here, back in 1990 recession, companies missed expectations by 15%. So we're going to calculate what happens if we get a 15% miss. Now, during the global financial crisis, companies missed expectations by 20%. So that is our downside, a 15% to a 20% miss. Let's put in the numbers and let's see what we get. So let's go back to our model over here. Okay, so this time we're going to say yes, we are going to adjust our earnings estimates to reflect our view. So we're going to put in the percentage difference. We're going to put in a 15% miss on earnings. Boom. If you put a 15% miss on earnings, the S&P valuation goes down to 3606. So that's the downside. Let me put that in. 3606 will be if corporate earnings come in 15% below expectations, which is what happened during previous recessions, correct? Now, what if it's really bad, like worst case scenario, global financial crisis, it comes in 20% below expectations? You know, how screwed are we at that time? Let's put in some numbers. Let's put in that number into the model, right? Let's put minus 20%, miss expectations, boom. The intrinsic value of the index goes down to 3502. 3502. So in other words, if companies deliver really bad earnings, 15% below expectation, then the S&P from current level should theoretically be at 3606, implying about a roughly 1.3% downside. If we get a 20% miss, then the S&P 500 should drop by about 4.1% to 3,502 points. So what does this look like on the charts? Let's take a look. So currently we are right here at 3655. It all depends on corporate earnings. If companies can meet expectations, then we should be up here 13% upside from current levels. But if companies miss expectations by 15%, then a market theoretically should be at this level, 3636, which is a 1% downside from current levels. And if companies miss earnings by 20%, which is really bad, that happened during the global financial crisis, how low should we go? Not that low, right? Down to 3501. That's a 4.1% downside from here. So in other words, what I'm saying is this: if you take a look at the market, it's already dropped so much that even if companies miss expectations by 20%, there's not much downside left. There's a lot more upside potential than downside risk at this stage. Again, if you take a look at history, companies tend to beat expectations more often than not. Again, take a look at this chart over here. You can see that, going back all the way to 1987, companies tend to beat expectations by at least 5% or even 10% at times. And for it to miss expectations, it happens very rarely, only during severe recessions, which again could be the case this time. So if the market, or if companies can beat expectations by 5-10%, then whoa, that's how we can get back to previous highs and beyond. And of course, eventually we will get there. The only question is how soon. Will it be next year or the year after or the year after? It will get there. Again, it's only a question of how soon. Now, here's the other good news. Even if companies miss expectations and the index drops, does it mean that all your stocks will drop? No. Does it mean that all sectors will drop? No. For example, during the financial crisis, it was mainly the financial stocks that went down, the banks, whereas consumer staple stocks, healthcare stocks actually went up. And back during the dot-com crash, it was the technology stocks that missed earnings, whereas the energy stocks, the financial stocks, went up. So it all depends on the kind of companies you hold. That's why it's really important as an investor to hold a diversified portfolio of different kind of companies. Like for me, I've got technology companies, I've got healthcare, I've got finance, I've got all kinds of companies, because I know that not all companies will have their earnings contract. If you hold great companies with earnings power, with pricing power, they can maintain their profit margins. And most of my companies are in that category. So what's the bottom line? The bottom line is a lot of people are fearful that company earnings will contract, corporate earnings will miss expectations, market will collapse. But I'm here to tell you that even if that happens, even if corporate earnings misses by 20%, the S&P 500 fair value should be at 3501, which is only a 4% downside from current levels. Now, I promise to show you the worst case scenario, which is what if the risk-free rate doesn't drop, inflation remains high, and the 10-year yield continues to stay above 4%. Now, in that scenario, yes, valuations will go down as well. And in that scenario, you can see that if earnings contract by 20% below expectations, we could see a 7% downside at current levels. And that is the worst case scenario. But the good case scenario is that if it meets expectations, you'll have a 6.7% upside to 3009. And if it beats expectations, which it normally does, then we could again have a lot more upside back to previous highs and higher highs. People always talk about the risk of staying in the markets, that if I stay in, it's risky because prices could go lower. But what I find even more risky is staying out of the markets. This is something that people don't think about. Why? Now, if you stay in the market, sure, there is a chance that prices could go lower in the short term. But if you hold on to fundamentally good companies that are making more and more money every year, if you hold on to index ETFs, the prices will always go up eventually in the long run. So while it may feel like a psychological loss in the short term if prices go lower, you always win in the end. Now, for people who get out of the markets or stay out of the markets, they may feel like they're psychologically winning when they see prices going down without them. Like people who are holding, their suckers, right? Because I'm not in the market. But eventually, guess what? Prices will always rise eventually. And chances are they will never get in the markets. Why? Because in their mind, next day will always get lower. It will always get lower. So they end up never ever getting in. And if the market suddenly rallies, they say, I've missed out and it's too high to get in anyway. And the market takes off without them. And that's what happens to most people. And as prices keep rising, they will ultimately lose out in the end in terms of huge opportunity costs. So which is better, to have a possible short-term psychological loss if prices go lower for a while, but ultimately win, or a short-term psychological win if prices go lower, but an ultimate loss of not growing your wealth? It's up to you, but I think that the second one is a lot more risky. And that's why for me, I choose to stay in the markets. But again, as always, I tell people, only invest with money that you don't need to use in the short term. If you need to use the money, do not invest it, keep it in cash for your expenses, for emergencies. But if you don't need the money, it's a surplus, invest. But don't invest everything all at once. Average in your positions, because even if it goes lower, you get a chance to add your stake in great companies at lower prices. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.